If you've been struggling to turn a profit or find a trading setup that doesn't feel like a wild gamble, this video might just save you from another round of "why did I enter that trade?" Today, I'm going to share 3 of the best price action entry strategies that helped us turn our sad little account into something worth bragging about. Here's the game plan. First, we'll break down supply and demand zones. Then, we'll dive into the best price action entry strategies. Of course, stick around to the end. Alright, enough chit-chat. Let's jump into it before you scroll away to watch cat videos. Alright, so let's talk about supply and demand zones and why they're so important. A supply zone is an area above the current price where the market keeps trying to break through but can't. It's like when you're trying to push open a stuck door. It's just not happening. From a price action perspective, the market sees this area as too expensive. This causes 2 things to happen. Buyers start closing their long positions because they don't want to overpay. Sellers start opening short positions because they're betting the price will go down. The result? The price reverses and moves away from this area. Now, on the flip side, we have the demand zone. This is an area below the current price where the market keeps bouncing off like a basketball hitting the floor. The market sees this area as a bargain, which triggers 2 actions. Sellers start closing their shorts because selling low isn't exactly smart. Buyers step in and open long positions because they see an opportunity to buy cheap. This double action makes the price reverse and head back up. So, to keep it simple, supply zones mean expensive, and that creates selling pressure. Demand zones mean cheap, and that creates buying pressure. Now that you know the basics, let's move on and talk about how to actually find these zones and use them to your advantage. Let's dive into some of the key supply and demand areas on the chart that we consider optimal trading zones. The first key level is what we call the turning point. This is where the market does a complete U-turn, like a driver realizing they missed their exit. These areas often show strong rejections, with the price failing to move any higher or lower and reversing direction instead. Now, let's look at some key points. The market was in a long-term uptrend until it reached this specific price level where the trend reversed completely. These are what we would traditionally call resistance levels. But for us, the real focus is on this turning point. Why? Because the market sees this area as extremely expensive, which is why it rejected it so strongly. This rejection gives us a clear signal that this level is what we call an extreme supply zone. If the price ever makes its way back up to this level again, it could present a perfect trading opportunity. This is where sellers are likely to step in with full force, creating a high probability zone to open short positions. Let's take a look at another example. Here, the price is in a strong downtrend, consistently breaking recent structures to the downside. But then, something interesting happens. We get a change of character right here. This gives us an early signal that the market is gearing up for a structure shift as it prepares to push to the upside. Now, if we look down here, we notice a turning point with a clear wick rejection. This is a classic sign that buyers are stepping in. So, we mark this area as our demand zone and wait for the price to tap into it. And as you can see right here, the price comes back, activates our buy order, and pushes beautifully to the upside. This is exactly the kind of setup we look for when trading with supply and demand zones, a strong shift in momentum, a clean demand zone, and a confident push in the new direction. Stick around, because next, I'll show you how to refine your entries even further for maximum precision. The market decided to do a complete 180 at this point, making it a turning point. And because it's the highest point, we crown it the extreme supply zone, the VIP launch for sellers. This is where we'd expect the price to hit a wall, get dizzy, and reverse to the downside. Classic supply zone behavior, am I right? Now, let's zoom in on these resistance levels down here. They're like the bouncers of the chart, stopping the price from sneaking above. Every time the price tries to break through, it gets a little tap on the shoulder, saying, "Not today, buddy." You can see the price reacting like it just got caught stealing cookies from the jar every time it touches the resistance level. Remember, the extreme supply zone is where we watch for the price to trip and fall. And those resistance levels? They're doing their job, keeping the price grounded like a strict parent. Keep an eye on these levels, and maybe the market will surprise us. Or not. Alright, next up, we have the major levels of market structure, the VIP zones of the trading world. These levels are like those versatile actors who can play both the hero and the villain. To qualify as a major level of structure, 3 conditions must be met. Multiple rejections. This zone has been rejected so many times it deserves an award for perseverance. Support and resistance in one. It's like the Swiss Army knife of zones, switching between support and resistance like it's auditioning for a dual role. Recently respected. If the market still respects this zone, it's like the zone is saying, put some respect on my name. When all 3 conditions are checked off, congratulations, you've identified a major level of structure. And trust me, these zones are gold mines for producing some of the most accurate trading entries. They're like your favorite coffee shop, always reliable and worth the stop. Alright, let's hunt for our major levels of structure. Down here, we've got a level where the price has been rejected multiple times, like it's trying to get into a club with the wrong dress code. Each rejection pushed the price to the downside, so we mark this as our resistance area, where price kept banging its head and failing to break through. But wait, there's a plot twist. Price said, enough of this, and pushed all the way up, breaking through our previous resistance like it found the secret password. Now, price is rejecting from the same area, but this time, it's acting as support, like the zone flipped sides and joined a new team. So, what do we have here? Multiple rejections? Check. Acted as both support and resistance? Double check. Recently respected? Oh yeah. With all conditions met, we found our first major level of structure. This zone is highly valuable and worth keeping an eye on. Now, let's head up here, where we see a similar example of a major level of structure doing its thing. Just like before, the conditions are all met. Multiple rejections? Check. Switched between support and resistance? Check. Recently respected? Oh, you bet. This zone is practically rolling out the red carpet for buyers, offering us a great buying opportunity. It's like the market's way of saying, come on in, the water's fine. This is the current price of US 30. And when we look to our left, we spot a resistance level that's been rejected multiple times. It's like the market's version of a do not enter sign. Now, here's where things get interesting. Price is currently tapping into this level. The big question is, will this resistance flip into support and give price the green light to push back to the upside? Or will it slice through this resistance like butter, leaving us all stunned? Honestly, it's a classic wait-and-see scenario for the coming week. If we start seeing multiple rejections from this level, then the odds are in favor of this resistance turning into support, giving price that much-needed boost to the upside. So don't rush, let the market reveal its cards. After all, trading is like dating. If the signs aren't clear, don't commit too soon. Next up, let's talk about the higher time frame key levels, the big players in the game. Why these levels matter? Think of higher time frame key levels like landmarks on a map. They help you navigate the market with precision. If price approaches one of these levels, you know something important is about to happen. Whether it's a bounce or a breakthrough, these levels are where the action starts. So, always check the higher time frames. It's like zooming out to get the big picture, because trust me, you don't want to miss the forest for the trees. This is the weekly time frame, and these visible levels are your weekly areas, the major zones that stand out like landmarks. But let's be real, most of us don't trade on these higher time frames. So what do? We jump to the daily time frame. Why? Because this technique lets you see the bigger picture while trading on the lower time frames. It's like getting a bird's eye view before diving into the action. By identifying these major levels of structure on the higher time frames, you're better equipped to navigate the lower ones. Pro tip: always align your lower time frame analysis with the major levels on higher time frames. It's like using a GPS. Without it, you're just guessing. And trust me, guessing in trading is about as useful as a chocolate teapot. Yes, I said that. In the next topic, we're going to focus on the 2 main types of price action setups: trend continuation and trend reversal. These are the setups we use to enter trade. Let's start with trend continuation setups. These are patterns where the market takes a brief pause before continuing in the same direction. Think of it like a pit stop in a Formula 1 race. The trend slows down for a moment, refuels, and then powers ahead at full speed. Picture this. Price makes a strong push to the upside, what we call an impulse move. Then, it starts moving sideways, consolidating. Here's where we draw a rectangle around this consolidation. Notice how the price fits perfectly inside that rectangle? This is a rectangle pattern, and it's a classic continuation setup. Price pushes up with this impulsive move. Then it consolidates, correction. Finally, it breaks above the rectangle and continues its upward journey. This pattern reflects the natural behavior of the market. Impulse, correction, impulse. So when you see the setup, you're looking to enter a buy once the price breaks above the rectangle. Sometimes, price might pull back slightly for a retest after breaking out, and then it resumes its upward trend. Be mindful of this retest. It's like the market catching its breath before the next move. Now let's talk about reversal patterns. Imagine price pushes up, consolidates sideways into a rectangle, just like before. But this time, instead of breaking out to the upside, it breaks below the rectangle and starts heading down. This is a reversal pattern, and it tells you that the trend is likely changing direction. Here is what you do. Draw your rectangle around the consolidation. If the price breaks below, you're looking to sell. It's that simple. Remember, the breakout direction is what tells you if it's a continuation or a reversal. Next, let's look at wedges. These patterns are slightly different from rectangles. Falling wedge, continuation. Picture price pushing up, then correcting downward, but in a converging pattern where the highs and lows get closer together. That's a falling wedge. Once price breaks above this wedge, it's likely to continue pushing upward. This is your signal to buy. Let's shift our focus to the right side. Rising wedge, reversal. Now imagine the price is pushing up, but forming higher highs and higher lows in a converging pattern. This is a rising wedge, and it signals a possible reversal to the downside. When the price breaks below this wedge, you're looking to enter a sell. Wedges are powerful, but remember to wait for the breakout before taking action. Finally, let's talk about flags, one of the most commonly seen patterns in the market. Continuation flag. After an impulse move to the upside, the price starts correcting downward in a tight, sloping pattern. This is your bull flag. To trade this pattern, wait for the price to break above the flag. Enter your buy as the market continues upward. Pro tip: flags are similar to rectangles, but tend to slope slightly, making them easy to spot once you know what to look for. Reversal flag. If the price starts correcting upward after an impulse down and then breaks below, this is your bear flag. Enter your sell once the price breaks below the flag. These patterns are reliable because they reflect the natural ebb and flow of the market. If you focus on just these three patterns, you can improve your trading significantly. Trust me, you'll start spotting these everywhere on your charts. Oh, and by the way, if you made it this far, thanks for sticking around. And listen, no making fun of my Indian accent, okay? At least I sound better than your trading account balance after a bad trade. Just kidding. Or am I? Cheers, and I'll see you in the next video.